Now is where we show the connection between that support and resistance and the range deviation pivot. What a range deviation pivot does is try to analyze the trend and puts a skew in for that trend. So if the trend was sharply up, the pivots above the market would be further apart than the pivots below the market. One of the key elements of those pivots is that they produce their 1, 2 and 3 standard deviations based on the opening price. So it gives you a fixed level of reference for the trading day. Now when price gets to the third deviation, as it did up at 145.79, what this reflects is the normalized limit of range for that trading day. And it's actually quite rare for the market to close beyond that level. When it does, it's normally shows that the trend is very strong. So an example would be here where we closed below, we did it 2 days running, and then finally we exhausted ourselves here. It's worth noting that the probability that you could hit 3 down 3 days in a row is approximately 1 in every, I think it's 4,000 bars. So it's a pretty rare occurrence on any market. However, coming back to this day here, the 13th of February, the critical thing here is that the limit of range is 145.79, which coincides almost perfectly with the resistance zone created on the market profile. So where we have limits of range based on the day with the limit or resistance points on profile, this is a very, very powerful point and suggests that at the very least the market should stop, have some sort of correction before making its mind up what it wants to do. If we now look at the chart a week later, it's here where the market actually peaked out at that 145.79 point. And we can see that the market actually reversed a considerable distance. It went all the way down towards 143.50. So there was a very sharp reversal. The market went down for about an hour, went sideways, and then collapsed in the afternoon. Now the commentary stated that it wanted to try and connect the S&P at 840 with the pound if at all possible. And what happened here at 9:30 in the morning London time was price went pretty much directly to that 840 point. If you look in the bottom left hand corner, you'll see that the high was 840.5. I also want you to look at where it says VTB high 3, where it says 840.48. I've just expanded that window up a little bit, so now it's a bit easier to see. So you can see that the high of that bar was 840.5 and high band 3 was 840.48. What this study is a volatility time band, and what volatility time bands do is look at momentum for the time of day as opposed to momentum on a continuous basis. It uses a proprietary way of analyzing what is the look back period and what is a normalized range for that time of day on any chart above 15 minutes. And so what this is doing, once again, when the bar opens, it gives you a fixed 1, 2 and 3 symmetrical standard deviation around that time of day. And so what has happened here is, again, we have a perfect connection where price has hit the third deviation for the time of day, which is also an incredibly powerful resistance point, and it's the control point of the entire sideways trend of the S&P dating back to last November. Now I've moved on to the British pound, and what happened here was the market was rallying very, very strongly, had good momentum behind it, and then at 10 o'clock, so just half an hour after the S&P had peaked at 840, the normalized range was set at 146.08, so the limit of range was at 08. We actually topped out at 03, but it was within that very powerful resistance zone of 88 to 16. Finally, we're looking at the concepts of overbought and oversold. If I just push the chart together a little bit, and what we have here is the case peak oscillator. Now what this study does is take up to 50 different moving averages together and then puts it in this green oscillator here, and then has a red line which is 2 standard deviations of its own momentum. Mathematically, therefore, when the green line goes beyond the red line, or the histogram goes beyond the red line, we are mathematically overbought and oversold. And when that oscillator changes direction, those purple lines, which are called peak outs, are confirmed. So here we have the market became oversold and we had a single peak out. But over here we had actually 4 peak outs, so a quadruple peak out. Now this is an extremely rare signal. Even getting triple peak outs relatively close together is very rare. And what this means is, in whatever time frame we were really looking at, the market at least has to go sideways and unwind the movement of the oscillator itself. This has a lot of implications for those of you who wish to trade options in terms of either granting vol spreads. A typical trade that I would look at doing here would be, when the market was at that extreme, would be to look to grant a 3 or 4 day 46 to 47 call spread. That way I know that the market should just unwind this situation, and because I'm trading FX, then I can do an OTC option, so it's a little bit easier in terms of stipulating the type of option that I actually want to trade. So in conclusion, what we had here was pretty much a perfect storm. Now if you were just trading one market, you might have to wait a while to get such a setup coming together. But if you're allowed to trade multiple markets, then you would normally get some opportunities, probably once a day, maybe twice a day. Depends how aggressive you want to be in terms of using the combination of overbought and oversold, which range deviation pivot you're touching, and how powerful the supports and resistances are. The key thing is that whenever these things happen, you have to be active. If you're in a current trade, then you should be at least taking some partial profits, and if you're looking to go against the trend, then you can afford to be aggressive. In terms of what makes the signal wrong on FX, normally if the move goes beyond 40 ticks, beyond the support and resistance, it's deemed to have been a signal that failed, or a level that failed. On the futures markets, those levels do vary, so something like the bunds, if it went more than 7 to 10 ticks beyond a support and resistance, it would have deemed to have not worked. On something like the DAX, then it's a little bit more volatile, so we'd probably give it around 10 to 15 points. If anybody wants more information or help or has some questions, you can go to www.i-traders.com and you can contact us here, and one of the team will be able to answer your questions. For those of you who are CQG users and then want to look at the studies, I'm contactable at Shaun, SHAUN, at CQG.com, or you can just ring any of your local offices and they'll put you in touch with me. Okay, thank you.